Hey there! Welcome to Usable Wisdom, where we will be sharing with you the latest tips and tricks in the financial space, as well as business and entrepreneurship. And for today's video, we will be talking about why living off dividends is easier than ever before. So make sure to subscribe and hit the notification bell so you'll be updated whenever we upload new videos. Enjoy! For most people, living solely on dividends has been a delusion for a number of previous decades. With the average S&P 500 dividend stock returning only 1.29% in December of 2021, the idea of being able to support a retirement with nothing but dividend payments, or even retiring early and living off dividends, seems absurd in today's society. The average dividend paid to shareholders is just about at an all-time low, according to the historical dividend yield chart. Companies then used to pay much higher dividends to stockholders in the early 1980s, averaging over 6%. And companies would typically pay dividends of over 7% or more in the 1950s, if we go back much further. Thus, if you can somehow only anticipate a 1.29% dividend yield, how much money would you have to save to live off dividends? Let's suppose you aim to earn $40,000 in pre-tax dividends every year, or $3,333 each month. With an average S&P dividend return of 4%, according to the Smart Asset Calculator, you'd need $3,140,775 in savings to earn $40,000 in dividends each year. And that's even before taxes if you don't do it through a retirement brokerage account. That is clearly out of grasp for 99% of the population. According to recent research conducted by Georgetown University Center for Education, the average USA bachelor's degree holder can probably earn around $2.8 million in their lifetime. Those with only a high school diploma could only end up earning $1.6 million during their lifetimes. That obviously excludes your ongoing expenses such as mortgage payments, children, vacations, and basic groceries and utilities. Therefore, despite having a bachelor's degree and saving every penny you earn, you won't be able to save up enough money to live a modest life on dividend payments. And thus, the majority of consumers prefer to invest in dividend growth companies, or exchange-traded funds, or ETFs, and gradually build up their portfolios over time. And the reality is that, especially if you're young, there's nothing wrong with taking this approach to investment. It's a decent plan to put money into a dividend ETF or an index fund every month and watch it grow. But there are a few aspects to note. To begin with, if you plan to invest in a retirement account with annual maximum contribution restrictions, you'll need to be a very excellent stock trader to save up the millions you'll need to live off profits. Either that, or you hope to start investing in an index fund as soon as possible and up to the annual contribution maximum. When we look at the average IRA balance for those between the ages of 55 and 64, we can see that it's only $120,000. It's evident that living off profits or even selling the capital is insufficient for a long period of time. What about if I invest in maybe an index fund in a non-retirement account on a continuous basis and then live off the money later, you might wonder. Once again, there's really nothing wrong with that as well. This is likely one of, if not the most common, ways to invest in the stock market. But there is something to keep in mind. However, there have been two significant developments in the stock market. One of these key events occurred within the previous few years, and another is currently taking place. Let's start with the first point, which is that the new investment vehicles now exist that give incredibly large and consistent dividend distributions. If you're a seasoned dividend investor, you're certainly familiar with some sorts of firms that aim to pay out higher dividends than the market average. This would include stocks such as REITs or real estate investment trusts, which normally yield around 4%, and business development businesses, which often yield around 7% to 8%. You can also invest in preferred shares of certain companies, which yield between 6% and 7%. Before we continue, please feel free to leave a comment below with your country of origin so that we can create content that is more applicable to your region. Now, let's move on to covered call ETFs, which are a comparatively new form of investment that offers a dividend yield of up to 12 and even 13%. The first covered call ETF was established in 2013, and since then, several corporations such as JP Morgan and Nationwide have introduced their own versions of similar funds. These ETFs use a covered call investment strategy, in which the fund buys a basket of companies in an index and then sells call options on those stocks. Every month, these options are sold, and the option premiums are distributed to stockholders as dividends. Every month, investors receive astronomically high dividends. QYLD, JEPI, XYLD, and RYLD are some of the most popular covered call funds. The one drawback to most of these funds is that they don't provide much in the way of development. In fact, many of these covered call funds see no increase in their share price. However, with such large dividend payments, a 12 or 13% annual yield more than compensates for the lackluster share price appreciation. Reinvesting your dividends will result in a big dividend snowball. These new calls are covered. ETFs are a blessing for folks who wish to start living off dividends sooner and with less money. There are two factors that make living off profits a lot easier. The second big event is the current situation in Ukraine. We're all aware of Putin's invasion of the country since it's still a crisis. But what many people aren't aware of is the catastrophic impact it's had on the stock market and will likely continue to have in the future. The S&P 500 is down about 14% from the beginning of the year as of the making of this video, mostly because of the situation in Ukraine. This has driven stock prices down across most sectors, and many dividend stocks, including covered call ETFs, are now trading at a discount. If this isn't your approach to investing, another example would be Store Capital, or STORE, which is also one of Warren Buffett's current holdings. This stock currently has a 5.28% dividend yield, due in part to the stock market downturn. It was yielding less than 4% not long ago, but market volatility has caused the yield to rise. If the stock market as a whole continues to decline, more dividend stocks will sell at a discount and thus provide higher dividend yields, allowing people to acquire more shares and earn more dividends. Hence, whereas I wouldn't desire awful things to happen, as an investor, I would take full advantage of any opportunity to enter an investment at a discount. Many equities and ETFs, as we've seen thus far, are already at a discount. If the dispute continues, industries will struggle for the foreseeable future, creating even more chances of buying dividend stocks. The rise in fuel prices will have a significant impact on practically every industry. Not to forecast a recession at all, but I believe we'll be stuck in a cycle for a length of time. If you do aim to engage in dividend stocks, I would recommend Dividend Aristocrats. These stocks have boosted their dividends at least once a year over the past 25 years. These stocks are deemed less risky than other dividend stocks. And while they normally have 2 to 3% dividend yields, during market downturns, their dividend yields can increase to 4 or even 5% or more. To conclude, I believe that it is possible to live off of dividends, and it is the ideal source of passive income. Although there are other ways to generate passive income, nothing compares to dividend income as a source of passive income. To make money from it, the minimum possible amount of effort is required. All you have to do with dividend investing is put money into a brokerage account and buy shares in dividend stocks or funds, then sit back and wait for the money to flow in. My advice to those of you who are committed to following this method of investing is to think about these two occurrences and organize your investments accordingly after thorough research and due preparations. Thanks for watching. It would be amazing if you subscribed if you learned something helpful from this video. Besides, you can unsubscribe at any moment, but otherwise, you'll always be the first to know about new money-making tips as we share them. Till the next one, goodbye!